Have you ever wondered how professional market analysts seem to just see around corners? How they manage to spot a massive market drop before the financial news even has a headline prepared for it? Well, in today's explainer, we're acting as a direct follow-up to our previous look at the composite illusion. We are conducting a complete forensic postmortem on a perfectly executed structural market call. We're going to break down exactly how the clues were laid out in real time, allowing for a hyper-precise forecast of the major equity reversal we just saw in early June. This isn't about guessing, folks. It's about the pure anatomy of a structural forecast.
Okay, let's dive into this, because we literally have the receipts. What you're looking at is a direct quote from analyst James Gaverty, recorded on May 30th, days before the market actually turned. He explicitly called out June 4th, stating that starting that Monday, a solid directional call could be made. I mean, this is the ultimate proof of foresight over hindsight bias. He basically planted his flag in the ground and told everyone exactly when the music was going to stop.
And so what actually happened right after that June 4th inflection point? The broader S&P 492 index took an absolute plunge, dropping by 99.18 points, or just over 2% by June 5th. This violent reversal proved that the drop wasn't just some random daily jitter. It was structurally inevitable. The pressure had built up, the release valve triggered exactly on schedule, and bam, the bottom fell out. But to truly grasp why this matters for your own market awareness, we need to understand exactly how this trap was set.
Section 1. The June 4th Validation.
So working backward from this market drop, we can uncover the precise structural breadcrumbs left during the final weeks of May. This step-by-step timeline shows you the buildup of pressure over 8 absolute critical days. It starts on May 23rd, when the initial cracks appeared in market breadth. 3 days later, on May 26th, a critical timing indicator fires a warning shot. By May 30th, the final macro warning is issued, pinpointing our exact target. And then, right on schedule, June 4th hits the inflection point. You see, structural pressure directly translates into an executive execution.
Section 2. Tracing the May clues.
Let's pop the hood and look at the actual contemporary notes and charts recorded back in late May. The profound disconnect revealed here on May 23rd is honestly staggering. Look at the top half. The SPY ETF was trending aggressively, just pushing higher and higher into all-time highs. Everyone thought the market was invincible. Well, almost everyone. Because if you look at the bottom half, that red line, the cumulative Williams advance/decline line had already peaked earlier in May and was actively sloping down. This is what we call a severe bearish divergence. It's essentially telling us that while the headline index was going up, massive underlying distribution was happening. Fewer and fewer stocks were actually pulling their weight in the rally. The foundation was rotting while the penthouse was still being decorated.
Now let's see how this builds just 3 days later. Here we have a timestamp Slack message from May 26th. Gaverty points out that the weekly S&P 500 just printed an 8 in the DMARC Sells Setup Countdown. Now, if you aren't familiar with DMARC indicators, they are incredibly precise exhaustion metrics. Printing an 8 meant the timing window was rapidly narrowing, officially kicking off a 4-bar confirmation window that strongly favored sideways to downward movement. The clock was officially ticking, and it was ticking loudly.
And here is the smoking gun, the contemporary notes from May 30th, issuing the final macro warning. You can see it clearly highlighted right there, forecasting June 4th as the inflection point where equity indices would stall out and start moving down. When you have structural deterioration aligning perfectly with timing exhaustion, you can confidently target a literal date on the calendar. This isn't magic, folks. It's just exceptional market mechanics at work.
Section 3. The S&P 492 Breakdown, Illusion versus Reality. To really grasp the genius of this call, we have to look back at our previous forecast regarding the composite illusion. We absolutely have to contrast the illusion created by those mega-cap tech stocks against the reality of the broader S&P 492. On the left, you've got the Mag 8, those top 8 mega-cap stocks that were essentially holding up the entire world. They hit a parallel exhaustion profile, eventually dropping over 101 points. But look at the right side, the S&P 492. This is the index with those top 8 giants completely subtracted. It printed a perfectly clean DMARC Sell Setup 9 right at the turn of the month. The broader market was already totally exhausted and triggered an aggressive downside reversal. The megacaps, they were just the last soldiers to fall. But you might be wondering, who is doing the buying and who is doing the selling? On those final days, a critical metric called the Williams Progo indicator just plummeted deep into negative territory, hitting a negative 5.70. Let's translate that technical jargon into plain English. It means the general public was eagerly trying to catch a falling knife. They were blindly buying the dip, while professional institutional money rapidly accelerated their selling and distribution. The professionals were literally handing the bag to the retail crowd right before the floor gave out.
And this brings us to a vital concept you absolutely have to understand: smart money fading. This is the structural mechanic where commercial or institutional investors heavily distribute their positions into an artificial, retail-driven rally. It creates the illusion of a breakout, but in reality, it's a massive trap. The smart money is just using the retail enthusiasm as liquidity to exit their positions at premium prices.
Section 4. Smart Money Fades Retail.
Let's look at exactly how this smart money fade was validated through the May 30th commitments of traders data. Think of it as the ultimate ledger of where the big money actually places its bets. Look at the Dow E-mini futures. The commercial net position, which is the smart money, was aggressively net short by 42,800 contracts. Meanwhile, speculator sentiment, representing everyday retail traders, was highly bullish. The Larry Williams COT index was sitting at a bearish 22%. All this extreme positioning created a massive distribution wall. The index had absolutely no choice but to fail directly into this wall, breaking down towards a structural macro targets near the 49,200 level.
Section 5. The next macro pivot.
So we've validated the anatomy of this past call, but as we know, the market never stops moving. Pivoting to the forward-looking forecast, the absolutely crucial point is understanding these exact structural targets derived from the same breadth models and daily chart profiles. Factoring in the momentum velocity, the market faces roughly 8 more days of downward pressure from that initial June 5th break. This projects an expected cyclical bottom, or structural exhaustion window, arriving right around Monday, June 15th. Now, because of the high-velocity nature of these DeMar corrections, a relief bounce is highly probable there. But, and this is super important, direction will require strict context validation when we hit that June 15th date. We need to see if it's just a dead cat bounce or the start of a massive liquidity flush and squeeze trending into mid-July.
Which leaves us with the million-dollar question as we monitor these charts. Will the June 15th pivot hold structural support and catalyze that mid-July macro squeeze? Or is the structural damage from that May distribution just too deep? You now have the exact blueprint and timeline to watch. Keep your eyes on the breath, watch what the professional money is doing, and never fall for the illusion of the mega caps again. Until the next market update, stay focused and keep learning.